Hi, and welcome to our market view presentation. Today we will perform a foreign exchange analysis on the currency pair AUD to USD. The Australian dollar is the currency of the Commonwealth of Australia. It's also the fifth most traded currency in the world, and the central bank is the Reserve Bank of Australia. While the United States dollar is the official currency of the United States, it is one of the most valuable to trade currencies in the world, with its central bank being the Federal Reserve System. So in 2014 to 15, the United States was Australia's third largest two-way trading partner in goods and services, which was worth a total of $64.5 billion. And in relation to this, both of the US dollar and the Australian dollar have floating exchange rates. And you would see in the graph below, it shows the history of conversion of AUD to USD in the last 12 months. With the current exchange rates being 1 Australian dollar equals to 0.7549 US dollars. So today, to perform this foreign exchange analysis, we will be reviewing and comparing indicators such as inflation rate, interest rate, growth rate, and commodity price.
The line chart shows consumer prices in the United States increased 2.4% year-on-year in March of 2018, about 2.2% in February, and matching market expectations, it is the highest inflation rate in a year. On a monthly basis, prices fell 0.1% after 0.2% rise and compared with forecasts of a flat reading. Gas prices went down 4.9%, the largest drop since May 2017. However, consumer prices in Australia rose 1.9% through the year to the December quarter of 2017, following a 1.8% rise in the last quarter and compared with the market consensus of a 2.0% rise. As inflation in Australia is relatively lower than the US. This means Australia's export will increase as well as demand for AUD. Oppositely, a decrease in demand for imports will lead to less supply of the AUD. According to the purchasing power parity theory, which is based on trade goods, if Australia inflation rate goes up, we should spend more money overseas. But with the US inflation rate being higher, by near future, we would assume AUD will appreciate against the USD.
So any other indicator is the impact of the interest rate on AUD and USD. So interest rate is the term used to describe the cost of borrowing money or the return to the owner of the funds, which are invested or lent out. The line chart shows the interest rate trend of the United States and Australia from 2008 to 2018. According to FRS, US fund rate is 1.75%. The key interest rate in Australia is 1.5%, and this has been the case since March 2018, which means that the nominal interest rate is lower in Australia than in the United States. However, taking into consideration the inflation rate of both economics, we can say that the real interest rate is lower in Australia than in the United States. And now we will show you in the diagram how this affects the exchange rate. We will use alternative view is to explain on inflation and the difference between real and nominal interest rates. For example, as you can see from the above section, the real interest rate in Australia is lower than the real interest rate in the United States. So a lower real interest rate in Australia means that encourage capital outflows, therefore increasing the supply of the AUD, because they can get a high return in USD than they can get in AUD. It also means that discourage capital inflow and decreasing demand for the AUD. So means that exchange rate from year 1 to year 2 and depreciation of the AUD. On the other hand, we also had a look at the economic growth rate. So what is economic growth rate, for example? It's derived as the annual rate of change at which a country's GDP increase or decrease. The graph provides some interesting data regarding GDP growth rate between the United States and Australia. We can see the Australian economic advanced 0.4% in the December quarter of 2017, and the US economic expanded and annualized to 2.9% on quarter in the last 3 months of 2017. Now, I will show you in the diagram how this affects the exchange rate. For example, when Australia have a lower economic growth rate, can lead to less imports and therefore decreased supply for the AUD. The AUD has risen from exchange rate 1 to exchange rate 2. However, decrease the level of overseas investment and therefore decrease demand for AUD. Then the AUD has fallen from exchange rate 1 to exchange rate 2. In the above case, the supply effect is to increase the price of the AUD, while the demand effect is to decrease the price of AUD. The net effect will depend on the strength of each of these separate factors and the slope of the demand and supply curves. It cannot easily be determined in advance, therefore it's hard to tell where this economics is coming from, but it comes from export and import. It would affect our and exchange rate.
So in relation to commodity prices, the World Bank expects prices to rise. For example, energy commodities such as crude oils and natural gases is forecast to rise by 4%, and non-energy commodities such as agriculture, metal and minerals are expected to rise by 0.6%. By looking at the changes in commodity pricing, we can make a conclusion in predicting the exchange rate. In conjunction with these pricings and also the inflation rates, we determine which country would be more cost efficient to purchase or invest in. So, judging from the historical data of inflation rates that was reviewed on both countries, we would expect both countries to have a small increase in inflation rates in the future quarters, and at this point we will assume that the United States will have a higher inflation rate compared to Australia. And also, with the United States having a stronger dollar than Australia as well, it would be more economical for countries to have goods imported from Australia than the United States, which in turn would result in an appreciation towards the Australian dollar. So in association with these indicators, we collected data on the balance of exports and imports in each country. And by comparing the contrast, we can tell if there is more demand or more supply in currency in the United States and also in Australia. So in Australia, it was reported by the Australian Bureau of Statistics that the export value was $34.23 billion AU in February 2018, while the import costs were $33.41 billion AU, resulting in a residual of $820 million approximately in exports. And so in the United States, it was reported by the US Census Bureau that the export value was $204.4 billion in February 2018, while the import costs were $262 billion US, resulting in a residual of $56.6 billion approximately in imports. So in summary, we would expect the Australian dollar to appreciate the USD in the next 3 to 6 months. By reviewing the indicators that we did analyze, we did notice that the US interest rate would be higher than Australia's, but in regards to the inflation rate, it would be much lower, which would mean there would be more demand for the Australian dollar. So theoretically, a high interest rate would strengthen the US dollar, but the interest rate can also be directly proportional to the inflation rate, which will result in an appreciation in the Australian dollar to the US dollar. And also, in relation to economic growth rates, we did notice that the US had a higher rate than Australia, but with this rate, it can be hard to predict how this would affect the exchange rate. And lastly, with commodity pricing increasing, what this actually means is, since Australia will be expected to have a surplus on exports, they will be expected to have a higher demand. And so this is our reference page, and thank you for watching.